Look at that number. 4.93%. That's the yield on the 30-year US Treasury right now. Sounds boring, doesn't it? Government debt that pays you back over 3 decades. A month ago, that same bond hit 5.2%, the highest in nearly 19 years, the highest in nearly 2 decades. And now, this week, traders are betting that the Federal Reserve will raise rates again, not cut them. While every financial channel on your TV is showing you the S&P 500 at a new record high, the bond market is quietly screaming something else entirely. And bonds are usually right. Here's the part that no one explains to you before they throw the numbers in your face. A bond is a loan. That's it. You give the US government your money, and in exchange, they give you a piece of paper that says, "I owe you." They promise to pay you back in 30 years. And every year until then, they pay you interest. That's 4.93%. And here's the kicker. The price of that paper and its yield move in opposite directions. When everyone wants a bond, the price goes up and the yield goes down. When people get scared and start dumping it, the price goes down and the yield goes up. So when you see the yield on a 30-year bond go up to 5%, that's not some abstract number in a financial supplement. It's the whole world quietly saying, "We don't trust this debt as much as we used to. Pay us more to hold it." And while bond traders are nervous, the stock market is having a party. The S&P 500 just crossed 7,400, a new record. Headlines everywhere. Stocks at all-time high. Sounds like good news. Now look at how the party is being paid for. Margin debt, the money investors borrow from their brokers specifically to buy more stocks, just topped $1.3 trillion. People are borrowing money against their portfolios at a rate we haven't seen since just before the dot-com bust in 2000 and just before 2008. Cash reserves at brokerages are near historic lows, below 4%. In other words, almost no one has any dry powder left. Here's why it's more important than the number itself. Margin debt isn't just an extra detail. It's historically one of the best warning signals we have. Look at the data. The lows of available investment credit preceded the major peaks of the S&P 500 by 6 months in 2000, by 4 months in 2007, by 4 months again in 2018, by 2 months in 2021. The relationship is not perfect, but it is persistent enough that it would be foolish to ignore it. Margin debt amplifies everything. On the way up, borrowed money buys more stocks, which pushes prices up, which allows investors to borrow even more at those higher prices. It's a self-perpetuating cycle, but the same cycle works in reverse. If prices start to fall, brokers issue margin calls, forcing investors to sell stocks to cover their loans, which drives prices down even further, which in turn triggers more margin calls. No one plans for a crash. The mechanism does it automatically. Let me introduce you to a company that explains everything that's happening right now better than any chart can. Oaktree Specialty Lending, one of the biggest players in the private lending space. Private lending is the new shadow banking system. Trillions of dollars in loans made to companies outside the regular banking system, mostly unregulated, mostly invisible to you. Oaktree's CEO, Armen Panossian, said something at an earnings conference call this year that should have been front-page news but instead got buried. He talked about loans made to companies that develop software related to artificial intelligence and said that these businesses are binary in their outcomes, meaning that if AI destroys them, they don't slowly decline, they go to zero. Around the same time, Oaktree quietly admitted that one of its previously restructured loans to a company called Pluralsight had gone bad again. Here's where the awkwardness begins. There's a technique that companies and lenders are now using called PIK, payment in kind. Normally, when you borrow money, you pay interest in cash every month, like a mortgage. PIK allows a struggling company to skip that. Instead of paying interest in cash, it simply adds the unpaid interest to the loan balance. The debt grows. The money doesn't change hands. On paper, the lender still counts that unpaid interest as income. In reality, nobody gets paid anything. It's debt on top of debt on top of debt. Imagine paying your credit card rent every month and then never paying it back. You here with that credit card, you're just letting your balance grow forever, all the while telling everyone that your finances are fine because technically the rent is paid. This is no longer a marginal gimmick. According to Lincoln International, a firm that rates about a third of all private loans in the US, the share of loans issued using PIK has more than doubled since 2022. And within that category is a category called bad PIK, companies that initially paid cash as usual and only later switched to PIK because they ran out of money. This bad PIK has jumped from about 2% of the market to more than 6% in just a few years, and it's been rising for 3 straight quarters. Fitch Ratings now estimates the real default rate in private lending at 5.8% over the past year, the highest level since 2009. Compare that to the headline figure of most articles, 2 to 3%. The gap between what is reported and what is real is where the bodies are buried. So now you have 2 pictures side by side. Picture 1, a stock market at record highs, built in part on record borrowed money. Picture 2, a world of lending beneath it, where a growing number of companies can no longer even pay interest in cash and are simply piling up debt one for one, calling it revenue. These 2 pictures are connected by one word: AI. Trillions of dollars are now being poured into AI infrastructure and AI-related software companies, both through public stock markets and private lending. And here's the part that almost no one says out loud. There is no version of this that is completely safe. If AI implementations disappoint, the infrastructure bets, the data centers, the chips, the loans that support them start to fail. If AI succeeds faster than expected, it starts to disrupt and destroy the very software companies that took out those loans in the first place. Panossian's own words. There is no net result here, just different ways to lose. S&P Global has calculated what needs to be paid. Risky corporate debt that needs to be refinanced is set to grow from $56.6 billion in 2026 to $215 billion by 2028. That's a nearly 4-fold increase in maturities of debt entering a market where yields are already high and where, if rates rise further, as the bond market is now pricing in, refinancing that debt will become significantly more expensive. Each of these companies will need new lenders to say yes, at a price they can afford. Many of them won't get that approval. This is the part where most financial content stops, gives you a vague, stay diversified, and moves on. We're not going to do that here. Who actually covers the losses when this private credit machine starts to stall, and how it already started, is the real story, and it's happening in places most people don't even think to look. Stay with me. It already started. In early 2026, some of the biggest names in finance, BlackRock, Morgan Stanley, Cliffwater, capped the amount of money investors could pull out of their private credit funds. Rate that again. These aren't shady offshore funds. These are the biggest asset managers on the planet, and they've put up walls to keep people from withdrawing their own money on demand. This is no ordinary Tuesday in finance. This is the closing of the fire doors. Here's why the fire doors are more important than the fire itself. Private equity funds promise investors something that stocks never do: stability. No daily price swings, no scary red candle on your screen. Pension funds, insurance companies, and increasingly ordinary people through retirement products bought into these funds precisely